Okay, let's talk about understanding indexed interest crediting. Now, what we're going to do here in this today and tomorrow, and frankly, if it takes longer, we'll keep going. This is not super complex, but there are complexities to it, and these things obviously involve a lot of math, okay? It's just the way it is. We're talking financial stuff here, but it's important that if you understand how these things work. I've often said in training producers, although we won't get into that depth today, is that any of these types of strategies you can do right there for your client on a hand calculator, okay? So it's not like it requires Excel or something like that to understand and calculate these things. It's easier if you do, but all of it can actually be done on a hand calculator. So let's go ahead and get into this. So the first thing we have to understand, we talk about indexed interest. This applies equally to both annuities and life insurance, like indexed universal life. They work exactly the same way. And they're based upon what's called a crediting formula. And there's various different types of crediting formulas. We're going to go through the basic ones today and tomorrow, because any offshoot of it is always related to one of the basic ones. Quite often, especially when you look at the carrier materials and stuff, you'll see these things called crediting strategies. Well, that's just a marketing term, okay? But the reason that, at least from a technical perspective, we call them crediting formulas is because they are very much math formulas related to all of this. Now, every crediting form is going to have multiple components to it. The ones we really have to understand are something called a crediting period, something called a participation rate, and a formula or a strategy, if you prefer the term, may also include something called a cap or a spread. In fact, most commonly will. And as you can see on the screen, it's the combination of how the carrier puts these different components together that's going to determine the potential interest crediting. What also comes into this is the index that's used, and of course how that index performs. Now, we're not going to get into understanding the different types of indexes in this training, although if you don't, I'd be happy to go through that in another session because it's a very important element as well, especially if you're talking to consumers. But right now, we're just going to focus on these crediting periods. And before we get into the different types and actually doing the math on these, we've got to understand these components. So the first one we want to talk about is called a crediting period. This is sometimes also called an index period. It means the same thing. This is simply how often is the carrier going to calculate and credit the interest, and that can be 1 year, that can be 2 years, heck, it can be 5 or even 10 years. There's almost everything under the sun that exists out there. The most common is 1 year, and there's a number of reasons for that. And let's look at something about the crediting period, and you'll understand why 1 year is the most common. The biggest impact that a crediting period has, in other words, how often we're going to calculate this interest and credit it, is most important largely when systematic withdrawals from the account are planned. Okay. So the thing about a crediting period or a crediting formula is that interest is only going to be credited at the end of that crediting period. So if it's a 1 year period, you know, at the end of that 1 year is when they're going to credit interest. And it's only going to be credited to the account value at the end of the crediting period. So let's assume we have a 1 year crediting period. As you can see, that little bar there, that represents 1 year. Now let's assume that at the beginning of that 1 year period, we have $1,000 in our annuity or our life insurance account value. Let's concentrate on annuities, it works the same way. Now, during the period of that 1 year, before the end of that crediting period, I take a 5% withdrawal. Then I'm going to take $50 out of that account value. You guys with me? Okay. So at the end of that 1 year, what's that?
Okay. So still here.
Okay.
So listen.
Okay, so what that means is I started out with $1,000. I pull out $50 or 5% or whatever it might be. So at the end of that 1 year crediting period, what have I got in the account? I got $950, right? So they're going to credit interest, whatever it might be, 1%, 5%, whatever, is only going to be applied to whatever amount of money is in that account value at the end of the crediting period. So One of the reasons the most common crediting period is a single year is because of this withdrawal thing. Let's take a look at another example. Let's say we have a 2-year crediting period. And there's a lot of, or at least a fair number of 2-year crediting periods out there. So again, at the beginning I have that $1,000, but let's just say that in the middle of year 1 or somewhere in there, I take that 5% withdrawal of $50. And then we move into the second year of the contract, but we're still within the first crediting period because it's a 2-year when I take another $50. Then at the end of that 2-year period, I'm going to have $900, right? So whatever interest is going to be credited is only going to be applied to that $900. So the longer we stretch these crediting periods out and people are making withdrawals, the less money is going to be in the account at the end of that crediting period when they determine any interest is going to be applied. Does that make sense to you guys?
Yeah.
Okay.
Yes.
Now, having said that, the longer crediting periods usually offer a higher potential interest in the rest of the formula. We'll get to that in a moment. But remember that that's not guaranteed. The one thing about indexed interest is that it's non-guaranteed. It's only going to happen if the index performs and et cetera. So as we stretch these crediting periods out, let's say this is a 2-year period. Let's say, if you can see my cursor, let's say the index went way up like this in the middle of it and then came right back down, okay? We could end up with a situation with a longer crediting period where the client's been making this withdrawal, so their account's much lower at the end of the crediting period, especially if it's a long one, like a 5-year one, and they end up getting very little or no interest. So that's the main issue with the crediting period, is if somebody's going to make systematic withdrawals. Now, the other thing to look at this is quite often, and then we'll look at caps and spreads here in a moment, but what you often see is if somebody's offering a 2-year crediting period or a 5-year, it looks like the potential interest is much greater because they're going to have a higher cap or a lower spread or something like that. We'll get into those in a moment, but you've always got to remember that's over a longer period of time. So you've always got to kind of watch at what these carriers are trying to do, okay? The other impact of the crediting period is simply a consumer thing. So imagine I'm a consumer. I put my $1,000 or my $100,000 into an annuity, and it's got a 2-year crediting period, right? So the first year goes by, and I get my annual statement, and it says I've earned nothing. Well, that's because there's not going to be any interest credited for another year. So some clients like to see some action every year. You know what I'm getting at? Even more so with, you know, these long ones that are like 5 years. You know, you could go 5 years before you know if you're going to earn anything in the damn account. And so for these two reasons, we typically, most products are designed with 1-year crediting or index periods, if you prefer the term. But there's everything under the sun out there. For example, Lincoln National tends to use 2-year crediting periods. SBL, a product I hate, uses a 5-year crediting period. And so the longer that crediting period, the bigger the risk the client is taking of whether the index will go up or down over that period of time. Now, marketers will offset that by saying, yeah, but we all know that the longer we wait for the market, the higher it's likely to go. And there's truth to that. But when we look at things like annuities, people are typically looking at, you know, safety, and they want, you know, they're very conservative. So there's nothing necessarily wrong with a 2-year, a 3-year, a 5-year crediting period on the face of it, other than the fact that consumers won't see any action for that time under statements. And again, if they're taking money out, their risk increases. So does that make sense to you guys?
Yes.
It does, John. So what's,
Okay.
I mean, I understand what you're saying, but that 5-year, let's say 5-year crediting period, marketer is telling you, hey, you know, just wait for 5 years, and you know how the market it is, and it's going to bounce back. I mean, is there any sort of logic? I mean, how do you pitch that to a client?
Well, there is logic to it, and the logic on that, that's a really good question, Vitaly. The logic there is simply this. We know from studying the stock markets for, you know, over 100 years, that over time, the markets tend to go up, okay? And so That's why they say the longer you have your money in the market, the greater the likelihood that you're going to make money. Well, we can apply that same thing here, okay? The longer I wait to calculate interest based on whatever formula I'm going to use, the statistical likelihood is higher or is better that, you know, it'll go up farther. It all depends upon when you start and when you end. So, for example, if we think about this, if I had a 2-year crediting period that I got into in 2007, okay, well, then I would have been shit out of luck because 2 years later, it's the end of 2009, and we know what happened, okay? The market had tanked 40%, so I wouldn't get any interest. On the other hand, if I had a 2-year crediting period, or for that matter, Vitaly, a 5-year crediting period that started in, say, March of 2009, well, we know that 5 years later, the market's gone up 150%. So it's all, so when they say the longer, the better likelihood, that's true statistically, but like anything involved with the stock market, okay, or these financial markets, really just depends on what it ends up doing, and you can't predict it. Personally, I have a bias toward just simple 1-year crediting periods because I think that the people that buy these products tend to be conservative and they want it to be as simple to understand, and they like to see something every year. That's my bias, okay? Does that make sense?
Yes.
Yeah, I'm usually seeing the 1-year things. I haven't seen it 5 years, but interesting. Okay.
Yeah, most commonly, Lori, you're going to see 1 year, okay? But I like to point this out and always start talking about this because there are products out there, and I've seen a lot of agents make mistakes in my career where they said, yeah, well, I picked that strategy because the caps were so high. I said, but yes, buddy, but it was on a 2 or 3 year crediting period. Oh, you see I'm getting at? And they didn't pay attention to it. And so that's why I start out talking about the crediting period. And for most of them, it's just going to be 1 year. You can pretty much kind of assume default, but I mean, it always says it on the apps, on the marketing materials. For example, I'm looking at a Global Atlantic sheet because I just pulled it just as an example, and they usually say 1 year annual point to point, the 1 year, or the 2 year point to point. So again, it's important. Hell, they got a 3 year one here on Global Atlantic. So it's just important that you understand that so you can explain that if you need to a client of what's happening, or a client calls you and says, how come I got my annual statement and there's 0 interest crediting? And if you look up what was done, you might say, well, because you went into the 3 year point-to-point with spread strategy. Okay, see what I'm getting at? And so you won't see any action there for 3 years. So that's just very important to be sure you understand that. Now let's get to the major thing on these things, these components. And there's 3 components that really drive a lot of these index strategies, because the crediting period is how often we're going to do it, right? They are the participation rate, a cap, and a spread. Now the first thing we've got to understand when we look at participation rates, caps, and spreads is this. These are used by the insurance company to limit the potential interest that they're going to have to credit relative to the increase in the index. Now, why would they do that? Why would we do it? It's because it's the very basis of index interest strategies. It's loss protection. In other words, the one rule in everything financial, especially if it has to do with stock markets or bond markets or anything like that, is you can never protect downside. You can't limit the downside without limiting the upside. It's impossible to do. That's why there's no such thing as an indexed annuity or an indexed life product that will give you guarantee that you'll never lose money and give you everything that the market does. It's impossible to do, okay? It's impossible for these financial companies to do that. And so these different elements, these 3 elements, participation rate, cap, and spread, are used to limit that. Now, how do they know how to limit that? Without getting into too much technicality, what they're doing when they set these rates, and then we'll look at how these things work, is let's say it's the beginning of a year, which happens every month, you know, as far as these products go. And what happens is there's a rate setting committee, and that rate setting committee within the carrier generally consists of people from the investment side. These are the people who are actually investing the money and buying the options and the bonds and all that support all this. You've got people sitting there from the marketing side, okay, and then usually you've got people sitting there from just kind of the business management side, and they all have different kind of goals. I've actually sat in these meetings, believe it or not, in the course of my career, my very odd career. And so what would happen is, how do they do this? Well, they'll turn to the investment side and they say, over the next year, what do you reasonably conservatively think you can make in the bond market? Because that's what all drives this, interest rates. And they might say, well, we think, bonds can return us 4%. Okay, great. And then the business people say, yeah, but we need to keep 1% of that, so the bonds are going to make 3, and then the investment guys say, yeah, but we might be able to get some more action by playing options, yada, yada, yada. See what I'm getting at? So what they're doing is they're forecasting the future. What do we think the market's going to do? Do we think the market's going to go up only 5%, or do we think it's going to do 15 this year? And relative to that, what can we actually make on our clients' money in the bond market? And between these and these complex formulas, they come up with these caps and participation rates and all of that stuff. So let's understand what these different components are. Start with participation rate. This is the most misunderstood element of indexed interest strategies, and it's the one that most producers, or many producers, explain incorrectly to their client, if they explain it at all. Now, as you can see on your screen there, what is the participation rate? It's the amount of the gross gain in the index that participates in the crediting formula. Well, that's a mouthful. What the hell does that mean? Okay, let's look at an example. Let's say over the course of the year, the index, say the S&P 500, does 10% without applying spreads, caps, or anything. Just say it does 10%, right? From point A to point B, as we'll see in a few minutes. Well, if I have a 50% participation rate, what's 50% of 10%, Vitaly?
5.
5, right? So what that would mean is, even though the index the index did 10, if I have a 50% participation rate, then only 5%, or 50% of that 10%, is actually going to participate in or be applied to any other element of the formula, cap or a spread, if they're using it. If I have a 75% participation rate, well, same thing. What would that be? 7.5%, right? Is it going to participate in or be applied to any other element of the formula? And if I have a 100% participation rate, well, then that's obvious, and that full 10% is going to participate or be applied to the cap or spread if it's used. Okay, so you don't want to get too hung up on this for a couple of reasons. There's usually 2 different types of designs out there. We'll be looking at them in a few minutes. Okay, so if I have a participation rate strategy that's less than 100%, let's say 50%, usually there will not be an additional cap or a spread applied to that. We'll look at that in a moment, but sometimes there can be, okay? In fact, the original designs of indexed annuities that came out in the mid-90s did not have caps or spreads, and we're going to look at those caps and spreads in a moment. They didn't even use them. All they used was participation rates. So I remember the first product that came out was Keyport. The company doesn't even exist anymore to my knowledge, okay? And they had the first indexed annuity out there, and it was simple. It said you get 75% of what, it's a 75% participation rate. That was the whole formula. So if the index did 10, you got 7.5% interest. If the index did 5, you got whatever 75% of 5 was. If the index did 20, you got 75% of that. It was pretty simple, really. I mean, does that make sense to you? Does that seem pretty simple?
Yep.
Lori? Yeah, I'm sorry. I'm just going back online because I keep losing service here. So.
Okay. So now, why then? Since that was pretty easy stuff, I mean, how hard is it to explain to somebody that your interest is going to be based upon whatever the S&P does or the Dow or whatever the hell they're using, okay, and you have a 75% participation rate, which means you'll get credited as interest 75% of whatever the index does. That seems pretty simple, doesn't it? Don't you think?
It does.
Sally?
Yes, sir.
So why then? Why then did they start with this cap and spread stuff? Here's why. It was a marketing issue, okay? It was a marketing issue. Producers, because they don't really understand math well, most of them, okay, had trouble explaining that, because let's say we had that 75% participation rate. The consumer would go, you mean the carrier keeps the other 25% of the gain? Well, the answer to that was always no, because that other 25% doesn't actually exist, okay, in terms of dollars, okay? But they would stumble over this. So as a result of that, what many of the carriers did is they moved to only using 100% participation rates, so that the producer didn't even have to try to explain how that actually worked. And they introduced either a cap or a spread. So right now in the industry, if a product uses a cap or a spread, in almost all cases, but there are exceptions, it will have an automatic 100% participation rate, so you don't even have to explain that part, okay? However, there are still pure participation rate products on the market. So typically we have a cap or a spread. We're going to look at those in a moment. We can pretty much assume we'll have 100% participation, but you want to check it, okay? You do want to check it, because a carrier can do anything they want, okay, when it comes to this. Everybody with me so far?
Yes, sir.
Okay. Now, that brings us into this thing about caps and spreads. Now, caps and spreads are pretty simple, okay? A cap is simply the maximum possible interest that can be credited. That's it, okay? A spread is the opposite kind of a cap. It is a percentage that's going to be deducted from the index gain before interest is credited. Now, let's look at these side by side so you really understand this. I think of a cap as a hard stop. In other words, if I have a cap, no matter what the index does, I'm not going to get more than the amount of that cap, right? A spread works differently. A spread is what I call a soft stop, and we're going to see what I mean by that. So let's assume we have a 10% gross index gain, okay? So the S&P 500 from point A to point B returned 10%. If I have a 5% cap, that's the maximum I can get, right? So I'm going to get 5% interest. In other words, with a cap, you get everything the index does up to the maximum of that cap. So here's what I used to do with consumers, for example, so they would understand caps. I used to do this in seminars. I had 60 people in the room, and I'd say, let's assume we have a 5% cap. If the index does 4, what do you get? 4. I wanted them all to say 4. The index does 5, what do you get? 5. If the index does 6, what do you get? And 5. You know what I'm getting at? That's it. That's the most you can get, okay? Now, a spread works differently than that. Let's take that same 10% gross index gain and assume I have a 5% spread. Well, 10% minus 5% equals 5% interest, right? That's how a spread works. But why do I say it's a soft stop? Because if the index goes higher, we're going to get more interest. Let's say we had a 15% gross index gain. Well, if I have that same 5% cap, I'm still going to get 5, right? Max I can get. Correct, Lori?
Yes, that is correct.
But if my spread is still 5, and the index does 15, 15 minus 5 is what? 10. So a spread is a soft stop. It's still going to limit the interest that's going to get credited, but it's not a hard stop like a cap. If that index goes way higher, then my interest can go higher depending on what that spread looks like, okay? Everybody with me?
Yeah, I got you.
Okay. Now, let's think of the opposite of that. Then in a few minutes I'll show you this in a spreadsheet. What if instead I had that 5% spread and the index only did 6. If the index did 6 with these same rates I'm showing you here, what would a 5% cap get me, Vitaly?
5.
5. If the index does 6%, but I have that same 5% spread, what's my interest going to be?
1.
Right on the money. See what I'm getting? So a spread can be a good thing if the index does really well, but it can bite you in the butt if it doesn't. Now, this is really important in understanding this stuff because in the last 2 or 3 years, because interest rates are low, which has been driving these caps pretty low, the fad in the industry has been to introduce what we call uncapped products. We've all heard about this, right? Uncapped strategies, right?
Right.
What that means is, first of all, there's no such thing as an uncapped strategy other than technically. They're using a spread instead, okay? With me? So depending on how high that spread is, it could be a good thing or it could be a bad thing. The reason I say other than technically there's no such thing as an uncapped strategy is because when people say that and when marketers say uncapped, what does it make you think? Oh, you're going to get everything. There's no cap, right? And that's not true. They're going to put a spread in there to reduce what that potential in crediting is going to be. So that soft stop can work in your advantage, but can also work in your disadvantage depending upon what the index does. But you guys with me so far?
Yes.
So when a carrier is doing its rate setting or designing a product, I spent 2 years just designing products, shoot myself in the head, okay, then what we're looking at is where are we going to set these part rates, caps, and or spreads to make the product both attractive to the consumer, attractive to the agent, and make sure that the carrier doesn't lose money on the deal. And so that's why these things constantly change. So Lori, every month when these rate updates come out, you see these caps go up or down or whatever the case might be, spreads go up or down, and they're simply reacting to the interest rate environment at the time, because the level of caps and spreads are largely tied to interest rates. There's some other factors that come into it, market volatility or expected volatility being one of them. But the major impact on caps and spreads are interest rates. So if interest rates rise, which means the carrier is expecting to make more money, more yield on their bond portfolio that supports all of this, because all this money goes into bonds, none of it goes into the market, okay? Then what we're going to see is caps go up and spreads go down. Now let's think about why that is. If I could make more money in the bond market, okay, which means as a carrier I can make more money with the consumer's money, and interest rates go up, I can make more, then I can increase that hard stop on credited interest in the form of a cap, right? Or I can make my spread lower. Either one results in more potential interest crediting to the client because interest rates have gone up. Does that make sense to you?
Yes.
Yeah.
You sound a little shaky on that for me, Lori. You sure you follow that?
No, I get it. I'm used to more of the caps, not the spread, so I'm
okay. Well, just think the easy way to think about that, Lori, is that they work opposite to do the same thing. Okay? So if interest rates go up, I can raise my cap or I can lower the spread. Each one would result in more interest for my client. The opposite is true when interest rates fall. Okay? If interest rates fall, we see caps go down and spreads go up. Why? Because a cap and a spread both are intended to limit potential interest crediting, but they do it in different ways. Okay? Caps a hard stop, a spread's a soft stop. So that's what you'll notice. You'll notice that when we get into these things like we especially saw in 2015 and early 2016, where interest rates, and the benchmark for that is the U.S. 10-year Treasury yield, as that thing was, it dropped 25% in a year, maybe more than that, okay? So we saw these caps go down and these spreads get bigger as that interest rate environment was going down. now we haven't been in a rising interest rate environment in recent memory, but I remember rising interest rate environments. We'd actually really have to go back to the 90s for that. Okay, well, we used to see these caps going up and spreads being almost nothing. Tally, I remember selling indexed annuities with 12% caps on them, just to give you an idea. Okay. And Lori, that wasn't because, and that was in the late 90s. It wasn't because the market was going up so much. It was because interest rates were so high. Okay, that's why that was happening. Oh yeah, I remember. In fact, I can remember, bitching to carriers, you drop this cap to 10%. How am I supposed to sell this thing? Okay, and so as crazy as that sounds right now, you know what I'm getting at? Yeah. Okay, and so it's really driven by interest rates. Okay. Okay, now that we basically understand these different elements of this formula, now let's look at the different crediting formulas and how these things actually apply to it. Now, the most common, the original and the most common type of indexed interest strategy or crediting formula is called an annual point-to-point strategy. And an annual point-to-point strategy is kind of the benchmark. So for example, if somebody's talking about a new product, I don't want to know, all I want to know in terms of the new product and the rates is I want to know what's the APP cap, the annual point-to-point cap. That's the benchmark. That tells me almost everything I need to know about whether I'm going to like it or whether I'm not. Okay? They may have a bunch of other strategies. I want to know what the annual point-to-point with cap is because that tends to be the benchmark in the industry. Now, to understand these different strategies and how they work, we're going to use this one-year market scenario right here that I just made up, okay? So we're using the same numbers for everything. So, with an annual point-to-point, the reason it's called that is because we're only going to measure the index point value twice, the starting value and the ending value. Now, if you're not completely familiar with indexes, remember indexes are measured in points, and every index point thing works different. We'll cover that in indexing. But the point is, every day, the value of the index changes based upon something called points, and every index uses a different point thing. So when we look at these blue bars here, all we're looking at is the index values, okay? And, these would have been S&P values maybe a couple of 3 years ago, but well, more than that. But my point is the same. I use these because I wanted real simple math. And you also notice I'm not taking it to double decimal points, which is how they're actually done, okay? So we're going to have with an annual point-to-point, what we're going to do is we're going to look at the starting value of the index, and then we're going to look at it 1 year later. That's it. Everything that happens in the middle doesn't count in the formula. That market could go way up, it could go way down, it doesn't matter. All we care about is point A and point B. Now that starting index value is the point value of the index either on contract issue day or at the beginning of a new crediting period, okay? So in my example here, we're assuming that the S&P or ABC index, whatever the hell it might be, at the beginning of the crediting period, okay, is 1,000. Now that index is going to bounce all over the place in the interim, but once we get to the end of month 12, we're going to measure it again. In this case, it's 1,100. That's point B. This index could shoot to the moon in the middle, okay, or it could drop to the bottom in between. It doesn't matter. All that matters is these 2 points. Now, what's the math on this? Okay. Well, it's relatively simple. Okay. The way we determine this, and I probably do 10 of these calculations a day, okay, is we take that point B, that ending index value right here, and we subtract it from the starting value. Okay, I'm going to give you an example once I give you the formula. Then whatever that gives us, we divide that by the starting value, and that gives us the percentage gain in the index. Let's apply some numbers to this. As we can see here, the index ended at 1,100, right? and we started out at 1,000. So 1,100 minus 1,000, okay, it's a 100-point gain, okay. We divide that by that 1,000 starting value, and that tells us that we have a 10% gross gain in the index. Now, you guys got calculators handy? Like hand calculator? Got one at your fingertips?
Sure.
Grab one. I want you to physically do this, okay? In fact, I'll bring up a calculator myself. I've got one here somewhere. And we're actually going to do this formula. Okay, so you can see my screen, right? So let's do this. What was our ending value? 1,100, right?
Yes.
So punch in 1,100 right on your hand calculator. Then we're going to go minus our beginning value, which is 1,000, right? And hit the equal sign. So that means that from point A to point B, that index rose 100 points. Everybody with me? You following me on that?
Yes.
Now we're going to say divide, I'll use that little thing, by again that starting value, which was 1,000. That equals 0.1, or 10%. So that's how you determine an index gain, okay? So for example, just to take this formula, this is the formula that everybody uses all day long in the financial world, whether they're measuring what the S&P 500 did in the last hour, the last day, the last 10 years, etc. That's the formula for determining any type of a gain in a stock or an index or anything like that. We also use it in this index interesting. That's it. That's all there is. Okay. Now, I'm going to put my calculator away. And I'll put it down. But that's not the whole thing. Now we have to apply that gain. Okay. So we got here and we applied that, and we got our 10% gain, right? Everybody with me?
Yes.
Now we have to apply that to anything other element or any other component that's part of that index formula, like a spread or a participation rate or et cetera. Okay? So now we're going to apply that to anything else that might be there. So what if we have a 4.25% cap? Well, that's really easy. Is the cap lower or higher than the percentage gain? Well, it's lower, right? That's the max we can get. So if our cap is 4.25, then we're going to get 4.25% interest, even though the index gained 10. What if instead of using a cap, it uses a spread? Well, if our spread was 5.75%, we take 10% minus 5.75, and we come up with 4.25% interest. Okay? Guys following me?
Yes.
Now, what if it didn't use a cap or a spread, or it just used a participation rate? What if it was 45% participation rate? Well, what's 45% of 10%? 4.55. And that's the interest that would be credited depending upon which one of those things it used. Now, Vitaly, what do you notice about those three green interest crediting things right there?
What do I notice about them?
Yeah. One uses a cap, one uses a spread, one uses a participation rate.
Well, in this particular scenario, they're about all the same.
Bingo. That's exactly what I wanted you to come up with. That's exactly what I wanted you to come up with. Okay? So, what that tells us right there is that for any potential scenario that an index can do, whether they think it's going to go up 10, 20, 30, 5, it doesn't make any difference. They can adjust a cap or a spread or a participation rate to come up with pretty much the same credited interest. Can you see that, Lori?
Yes, I see. Yes, I know exactly what you mean. Yes.
Okay, so this is important when we're looking at what these carriers are doing, because sometimes you'll see these things and some marketer is trying to tell you, oh, look, this thing only has a, you know, this much spread or this much cap or something like that. Well, trust me, guys, okay, those things have been designed to deliver pretty much the same credited interest based upon what the, you know, the crystal ball gazers at the carrier think that index is going to do. Now, if the index goes way higher and they have too low of a spread, well, then the consumer could make a lot more interest. You see what I'm getting at? But that's how that works. Now, let's look at this in more detail, because this is where it gets kind of fun. Well, you know what I mean. So what we're looking at here on this spreadsheet is that exact scenario that we just looked like in that market thing. So in the first, we started out, our starting value was 1,000, remember? And we ended up at 1,100. We don't care what happens in the middle of this. We started 1,000 and we go to 1,100. So let's look at this column, an annual point-to-point with annual cap of 4.25. So point A was 1,000, point B is 1,100. So the index did 10%, right? And then we apply the cap and we get 4.25. So we look at here, now we're assuming instead of that cap we were using a 5.75% spread, so we still got 4.25. But if that spread was 4%, then the client could get 6. See what I'm talking about? Versus if that spread was, I don't know, 8%, the client might only get 2. Okay? Everybody with me?
Right.
Here we see that participation rate. Index still does 10, okay? If I have a 45% participation rate, my client gets 4.5%, right? Mm-hmm. But what if I had a 60% participation rate? Well, they would get 6%. So you see how we can manipulate these different elements to come up with largely the same result. Dig what I'm saying? Okay.
Yeah.
Just depending upon what we're trying to achieve. Okay. So we can really play with that. Now I want to show you something different. This index scenario right here, I created just randomly for the most part. Okay. And I created it randomly because I wanted the math to be really clear. You know, 1,000 to 1,100, but it doesn't really work that way in the real world. Let's take, for example, this same set of numbers here. And we're going to use what actually would have happened over the course of the last 12 months in the S&P 500. Now, the first thing we notice here is that instead of, we always have a point something. That's how these things are actually done. The index doesn't end on or begin on 2079. It's always got a couple of decimals after it. Now, in this scenario, let's take the same 4.25% spread we were using. Oops. Okay. Doesn't matter. Now, in this scenario, which is the last 12 months to the end of September, I believe it was, okay, we started out at 2079, ended up at 2126, okay. The index only did 2.25%. So if I have a 4.25% cap, my client gets everything up to the cap, right? So they would have gotten 2.25%. But if I went into that scenario with that 4.25% spread, I come up with a negative number, so that means client gets 0. They can never go backwards. So if it's a negative, the client would have gotten 0. What's my point? A spread can completely wipe out any gain if it's too high. In other words, the index actually did 2.25, but if I have a spread higher than 2.25, my client's not going to get any interest crediting at all. Do you follow that, Lori?
I think so. I'm just practicing as you're talking. It's kind of looking.
Okay.
Yeah.
Okay.
If the carrier knows that the market, if the carrier knows a year in advance that the market is going to perform poorly, or let's say not up to the, you know, certain percentage, why even offer options like spread if your sole goal is to make your clients money so you can make money?
Because they don't know. Nobody knows what the market's going to do from day one. So how do they make that determination? They base it on history and stuff that's going on, okay? In other words, there's a whole industry out there of prognosticating on what the market's going to do based upon all these different factors and these histories and yada, 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 right? technical analysis, charting analysis. I mean, it's what fills the pages of MarketWatch and CNBC, okay? So based upon their own view of it and their professionals, they they make a call on it, and you can kind of tell that by, without getting too detailed, where options prices are and stuff like that, okay? So for example, if they thought this market was going to do 2 1/4, okay, they might do this with their spread. Drop it to 150, see? Now at least my client gets something, okay?
Yeah.
Okay, or they might, you know, drop this participation rate to 50, okay? At least the client gets something, okay? So in this case, you're talking to the market and you say, no, I'm telling you, Vitaly, that spread's only 1.5%, okay? When the cap's 4 1/4. Look, if the market does 10, your client's going to get 8 1/2, right? Well,
Yeah.
now that the market only does 2 1/4.
Right.
Now, what this brings me to, guys, okay, is this. The single most question that people like I get from producers, particularly ones, not only new ones, you get this from seasoned guys, okay, is, John, what's the best indexed interest strategy? And the only thing I can ever tell them, I said, I don't know, it depends upon what the market does. And they get all upset. I hate that. You've got to tell me. I said, what works best this year will probably not be best next year, okay? It's impossible to tell, okay? So we tend to make these what we call allocation decisions. You know how on a application, Laura, you can say put so much in this point to point and so much in this thing and et cetera. We're tending to make those either on what we just have a preference for, okay? So for example, what's my bias? And it's only mine. I'm not saying it should be yours. I am biased towards simple annual point-to-point with caps, okay? Well, John, how can you say that? Because if the market goes up higher and the spread's right, they could get more. Yes, they could, but a simple point-to-point with a cap is very understandable by most clients. And again, we are not doing investments here. We are doing guaranteed conservative products. So I like the annual point-to-point with a cap, as long as that cap is decent, okay, because it's very easy for my client to understand what they can potentially get. Mr. and Mrs. Smith, this thing has a 4% cap on it. That's the most you're going to make, no matter how much the market goes up. If the market ends up negative, you don't lose anything. If it goes up 3%, you'll get 3, but you will not get more than 4. That's how this works. That's very simple for people to understand, okay? And if they're that type of conservative investor, who that's why they're buying this product, because why are they buying this product? They're buying this product predominantly not to lose money. So that's the number one thing. So therefore, the gain on the contract, okay, we don't know what it's going to be, but with a cap, we know what the maximum will be. Does that make sense to you? Other producers have a bias toward a spread type product, okay, because they say, well, you know, if the market really does well, they're probably going to make more than they would on the cap. Yes, they're absolutely right. But if the market performs low, like we have an example here, only does 2 1/4, well, that spread could actually result in less. So the point is, we really don't know, okay? And most people don't make these decisions. They rely upon us as the producers to do these allocations for them, okay, or to make our recommendations. So my rule on this, but everybody has their own opinions and they're legitimate on it, is the first and foremost thing is to use the allocation that your client can understand, okay? Because if the client understands what can potentially happen, then you're setting that expectation. So if you told them you're not going to make more than 4 because that's the cap and the market does 15%, they may be unhappy they didn't get the 15, but it's not like they say, hey, how come, you know, I didn't get anything? Or I only got 4. So there's different views on this, okay? Now, when they develop these things, they do all this back testing and stuff, what's called Monte Carlo simulations. And, you know, that shows you what might have happened in history, but I wouldn't, you know, I don't necessarily consider it to be I don't believe that what happened in the last 30 years is any real reflection of what's going to happen in the next 30 years, but that's my opinion. Okay, so I'm going to put this back to where it was, and I'll go ahead and put this back at 4.5 or wherever I was at. 5.7. I'm just resetting this, guys, is what I'm doing here, okay, because we're going to use this again in a moment. So let's put this spreadsheet away, because now we've seen how the dynamics of that can work, and I hope that was helpful to you to see those changes, okay. And now we're going to go back, and now we understand the basic annual point-to-point. So again, very relatively simple. It's the simplest of all, well, it's the second simplest of all indexed interest strategies, okay? Now here's one other thing you want to be careful of. You will see product strategies out there that use a combination of less than 100% participation, and they'll still apply a cap, or they might have less than 100% participation and apply a spread. Generally speaking, that's going to be death, okay? In other words, if they're applying more than one of these limiters, does that make sense? The odds of that product doing really well are not that great, okay?
Right.
You know, imagine if you would, if we had both a spread and a cap. So we're going to take a 4% spread and then max you out at 4% cap. Come on, you know what I'm saying? And so that's the kind of stuff you kind of need to know. So annual point-to-point can be out there with either a cap, that's the most common index strategy. It can be a annual point-to-point and they apply a spread, or it can be an annual point-to-point and they apply just some percentage participation rate, okay? The odds are, all other things being equal, they're all probably going to credit about the same interest. At least they are intended to. But again, the market may do something different than the carrier expected, okay? I'll give you a quick anecdote on that. One time, this is probably 10 years ago, I'm in a car in Tampa Bay, and I'm sitting in it with the chief marketing officer, the chief distribution officer, and the chief, I don't know, field rep for Forethought Life, okay? And we're driving to this big meeting. It was like midday, and we're going to some meeting I'm going to present at. I don't remember where the hell it was, somewhere in Tampa. And here's the conversation that these three guys are having. We've got to drop that strategy and get it the hell unavailable like right now, okay? They're talking to the home office saying, don't let any more money go into, I don't remember what the index strategy was, Vitaly, okay? Cut it off, cut it off, cut it off. Well, why? Because the market was doing different than they had predicted that it was going to, okay? So maybe they had too high a cap or too low a spread on that strategy, and the company's losing its ass, okay? So even though they try to predict this, you know, you can't predict it with certainty. So anyway, let's look at the next. Go ahead.
So it's not uncommon for an insurance carrier to stop certain investments from going through certain caps. I mean, they can cancel them at any time, or
they can do whatever they want. They can't change it, Vitaly, once a contract is issued. So let's say, for example, we have a contract and it's gone into effect, and 50% of the money's in the annual point-to-point with cap and 50% of the money's in the annual point-to-point with spread, just to give an example, okay? Once money's in there, they cannot stop that for that client until the end of the crediting period. But at the end of that crediting period, they can say this strategy is no longer available, okay? Or they can say, or they can change these spreads and caps at the beginning of every crediting period. These are why we call them the moving parts, okay? So, for example, this is why renewal rates are important and things like that. So right now, as an example, Vitaly, I'm looking at this rate sheet, okay? And I'm seeing the one-year annual point-to-point with cap, S&P 500, has a current cap of 4.25% on it, okay? So I put my client's money in there. When they come up with renewal, okay, they could raise that cap or they could drop it to 2, okay? And here's the problem with that, is as producers, we don't always know what they did. In other words, when these interest rate sheets come out every month, they're for what we call new money, all right? But on existing contracts, the renewal rate could be higher or it could be lower. And it doesn't have any real relationship with most carriers of what the new money rates are. You follow what I'm saying?
Yeah, absolutely.
The only way we know what they're doing with renewal rates is when we get copies of our client's annual renewal statement and see what their choices are.
Mm-hmm.
This is why when we look at what carriers we like to use, their renewal rate histories are very important. So for example, American Equity has a very strong renewal rate history, okay? They don't tend to screw existing clients at the expense of new money, okay? So very strong there. Jackson National has very strong renewal rate histories, okay? So in other words, take American Equity just as an example. Their current new money rates may not look that great relative to some other carriers' options, okay? But we have a pretty good idea that for the 10 years that contract is in force, that rate's going to stay pretty much where it's at, versus other carriers might drop them, you know, down to the minimums, okay? So it just depends upon the carrier. The other thing that tends to happen is once in a while, as you know, one company buys another company. I'll give you an example. When Aviva got bought by Athene, okay, several years ago.
Right.
Well, I can think of 2 years ago, I'm seeing these client statements come in from these Aviva policies that were issued 10 years ago, okay, and they've taken those renewal rates down damn near to the minimum, okay, because that carrier that bought the other carrier, they don't give a shit about the old Aviva stuff. They have to maintain it, you know what I'm getting at? But if they have the ability to take those rates down, because it's going, you know, they're going to make more money, sometimes they'll do it. And so they can change that. So that is this is what is considered one of the major downsides, or it's one of the major issues that people that don't like indexed annuities, or index life for that matter, use to point against them and say, yeah, they can, it's up to them whether they change these rates, and they don't need your permission, okay? The contract says they can change them. And you can pretty much bet they're never going to increase them, okay? But they can take them down. And so that's a criticism, okay? So again, that's why we look at the renewal rate histories of the companies, at least the companies that will give them to us and track them. And again, American Equity, for example, is very, very strong on that. And so are many others. So you've got to be aware of that. Okay, let's look at the next common type of indexed interest crediting form. It's called an annual monthly average. It'll go by various names. It could be called the 1-year annual with monthly averaging, but what they're doing is it's called an averaging strategy. This one works a bit differently, although there are similarities. So here's our same hypothetical index. Now with the monthly average, we're going to do more measurements throughout the course of the contract year. We're going to go ahead and measure that point value at the start, just like always. But then we're going to look at the index value every month. So here's our start value. Again, it's still 1,000. But now as we go through the course of the year, we're going to record what the index point value is every single month of that year. So we'll have 12 of those. Okay? Whereas remember before, with the straight annual point-to-point, we don't care what happens in the middle, right? Now we care what happens in the middle. And then we're going to average those, okay, at the end. So let's look at the math here, okay? To figure out the gain, we're still going to use this starting value as part of our formula, but now we're going to, as our first calculation, we're going to look at the average of all of these index values. So all they do is they add them up and you divide them by 12, right? Okay. And then we're going to subtract the starting value from that and then do the same thing we did before. Divide it by the starting value, that'll give us our gain, our gross percent gain. So let's look at the math on this. If I take all of these different monthly index values, and I add them all together and then divide them by 12 or average it, it comes out to 1057. So remember with the annual point-to-point, this first number in our math formula was this last number here, 1100, right? Now, with averaging those, it's only 1057. So I take that minus my start value, just like we did before, 1,000, divide that by 1,000, just like we did before, and it's going to give us our percent gain. So if we think about what was our gain with the annual point-to-point, it was 10, right? Well, now by averaging these values, it's reduced that down to 6, okay? But that's just in this example. If this market had shot way up here, okay, and then came back down, it could be more than 10. You just don't know, all right? And then we're going to do exactly the same kind of math. So grab your calculator again. We're going to go through this, okay? So we're going to do the same thing. The only difference here is I'm going to shortcut adding up 12 numbers and dividing them by 12. Trust me that it's 1057. So again, same thing, 10057. That's our average of all the monthly values minus 1,000, which is our starting index value, equals a 57-point gain. And then we divide that by that starting value again. And, you know, it's 0.57, call it 6. You see I'm getting that? Okay. So just like we did before, now we're going to apply that to any other element of the formula that might exist. Okay. Is there a cap? Is there a participation rate? Is there a spread? So now I have a 6% gain based upon that monthly average methodology. So if again, if I have a 4 1/4 cap, it's the most I can get, I'm going to get 4 1/4. If I have a 1.45 spread, I'm going to get 422. Rate, I'm going to get 425. Again, what do we notice about those green numbers? They're all pretty much the same, aren't they? Again, I can manipulate based upon what I think the index is going to do. I can manipulate my cap, my spread, or my participation rate to achieve the same basic end goal, because that's what my investment people said we can make, they think they can make in the bond market this year. Okay.
Okay.
Okay, so now let's bring our spreadsheet back up and look at this same kind of example thing. But now we're going to look at this strategy. So, my stupid thing. Okay, so here's that example we just looked at. This is the same exact scenario that we just looked at in the PowerPoint, but now we care what happens in the middle. We came up with a 6% result. If I'm using a 4 1/4 cap, then I get 4 1/4. If I'm using a 1.45 spread, I'm getting 422. And a 75% participation rate, I get 425. So that's roughly how the carrier would like to see that happen, right? But if they guess wrong, okay, all right, what if my cap was only 3? I would have only gotten 3, right? Or what if my spread was too high? 3.5, okay, I get 2.17, okay? Or if I have my participation rate too low, 35%. You see I'm getting at? So it just depends upon, you know, how these different things work together to do this, okay? Now, let's set these caps back to where I had them and see what would have happened over the last year. Oh wait, no, where's that? 425, and is it 145? Okay. And I think I did 75 here, right? Yeah. Okay, now let's bring in that scenario over here again with what actually happened in the last year through the end of October. Ouch.
I've noticed you doing a fiscal year. Why do you do fiscal year?
Fiscal year, which, oh, I didn't. I just wanted the most recent 12-month results.
Okay.
Pure coincidence. Pure coincidence. Because remember, Contracts are issued typically every 2 weeks, so these things are constantly shifting to the carrier.
I
Okay.
got you.
So look what would have happened in the last year if these were my scenarios. Okay.
Yeah.
Wow. So anyway, that's where this stuff can go haywire. Gross index result. What's going on there? Average. Oh, you know why? You know why I got 0 right there? Because it's being averaged, okay, in this particular case. So again, that can end up in, different scenarios. So an averaging strategy over the last year would have got 0, which means actually I get 0 here. I didn't bother to mess with these formulas to reflect that, but I could have, okay? In fact, in any of these, I would have gotten 0 interest credited, okay, because of that averaging element that got thrown in there. Versus in the same scenario with the annual point-to-point, at least I would have made 4 1/4 or something. You see I'm getting that? So, goes back to the unpredictability of it. Goes back to the unpredictability of it. So if I had a client in the last year, okay, where in this market scenario, they had made, as I recall, about 2 1/4, but instead I had put their money in this average thing, they get 0. And they come back and say, how come the market did, 2 1/4 and I got nothing? Well, because we were in the monthly average strategy. So this goes back again to, it's basically educated guesswork, guys, okay? But that's how
did you become biased to annual point-to-point ever since the whole 2007 dealio?
No, not really. I'm biased toward that because it's simple. Because it's simple for people to understand, okay? Because from my perspective, and it doesn't have, these are not investment products, okay? If my client absolutely wants safety and needs to know how much they're going to make, I'm going to sell them a MYGA, not an FIA.
Yeah.
Okay. All right. So if they want no loss, but with the chance that something more than a MYGA might pay them, that's when we go to the FIA. Okay. But they just simply need to understand, you could end up with less, or you could end up with more, or maybe nothing. It just depends. Okay. Here's the thing about this averaging. I can tell you that kind of historically. Okay. Monthly averaging tends to work well in market scenarios where they start out like this, and watch my cursor, and they go way up in the middle, and then they come back down, okay? That tends to be where averaging will beat a point-to-point. Does that make sense to you, Vitaly?
It does. Because,
okay.
Obviously.
Yeah. In other words, think about I wish I had a whiteboard, but I don't. In a point-to-point, theoretically, we could start out at 1,000, the market could go way up, and it could end up right back here at 1,000, huh? And if those are the only 2 things I'm using, well, they get 0, even though the market went way up in the middle. That is why, my friend, the monthly averaging methodology was introduced. Because when these products first came out, there was only annual point-to-point. And people were complaining, yeah, but I missed everything that happened in the middle, and it went way up, okay? So that's when they said, okay, we'll do this monthly average thing. But again, it depends on what the market does. You know what I'm saying? Yeah. Now, understand, in any market scenario where we start out here at 1,000 and it just keeps going up all the time, all right, any of these things are going to do well.
Right.
Okay? Any of them are. Of course, if we know that's going to happen, we'd probably be best off just to buy S&P index funds, okay? So coming from, the point is that we don't know that that's going to happen, okay? So that's the scenario on these things. That's how the annual monthly average works, okay? Make sense to you?
It does.
Okay, what questions do either of you guys have on anything we've covered here so far?
I think I'm up to par.
Okay. So, do you have a better understanding of these 2 scenarios and what part rates and all of that stuff are at this point in time?
I do.
How about you, Lori?
Yeah, I feel pretty good about it.
Okay, cool. So again, so when we look at these rate sheets, okay, we understand. Now, I want to tell you about this rate sheet I'm looking at because it'll give you an idea. Now you're going to be able to apply something. I have a 1-year fixed rate of 2.1. In fact, write this down. Write down fixed at 2.1. Let you guys write this down. 1-year annual point-to-point with cap. The cap is 4.25. Write that down. And I have a 2-year point-to-point with a 2.75% spread. And that
was that
last one, what's that?
What was that 2-year point-to-point?
2-year point-to-point with a 2.75% spread.
Okay.
Now, looking at those three, I did that one, I did that one, and I did that one. I can be certain to make 2.1, right? I might make 4.25.
Mm-hmm.
But what about that 2.75 spread? Does that sound like on a 2-year thing that might be the best option?
If it's only if it's only growing by 6%, I don't think so.
Okay, but over 2 years. Let's say it goes 6% a year, 12%. Wouldn't that sound like be the good thing?
12, 2.75 spread. Yeah, it'd be higher than the cap, right, of 4.25.
Okay. Yeah, exactly. Now, I'm messing with you here because there's a piece of information I didn't give you, okay? That 2-year point-to-point with spread is not on the S&P 500.
No.
Okay? It's on this BlackRock Diversive Volatility Control Index, okay?
Okay.
So, what the hell does that mean? Okay, that's one of these made-up indexes, okay? And anytime you see an index option that has something like volatility control in its name, okay,
Yeah.
the hairs on the back of your neck need to go up a little bit. Why? What did we learn at the very beginning of this? You cannot limit downside without limiting upside, right? So they'll give that low spread, okay, that looks really attractive. Oh my God, only a 2.75 spread, man. If the index does 10 over the next couple of years, you know what I'm getting at? Oh wait,
good, yeah.
It's on a volatility controlled index, and what that means is that index has components in it and is being managed to limit the growth of the index. Okay? In other words, if the S&P 500 in that same period of time goes up, I don't know, 15%, that volatility controlled index is probably only going to go up maybe 7, because it's designed to do that, because they're trying to limit the downside in the index. In order to do that, they have to limit the upside as well. So you got to watch out for that. When we get to training on indexes, I'll get into more of this in detail. But the reason I wanted to point this out is because if I'm a typical producer who doesn't really give a lot of thought to this stuff, and I'm looking at this rate sheet, I go, oh my God, 2 years and only a 2.75% spread, that's where to put the money, okay?
All right.
Now there's some out there that are a little tricky, okay? That one's kind of clear because it's called the BlackRock Diversity Index, okay? But for example, F&G promotes a product with a index strategy that's based upon the S&P 500. I don't remember quite what it's called, but it's volatility controlled 5% index, okay? And they have either a really low cap, really high cap, or a really low spread on it. And what the marketers tell you is, look, this is the S&P and the spread's only 1%. It's not the S&P. It's a subset of it that's being managed to only grow 5% a year. You see what I'm getting at? And right. So that they can limit the downside. So this is where you've got to understand this stuff so that you can make a call on that. Okay, that doesn't necessarily be bad. It might perform okay. But anytime you see something like volatility controlled or blended or anything like that, it doesn't necessarily mean it won't perform well. What it means is it's not a pure, what we call, equity index. The S&P 500 is the stocks of the 500 largest companies, or 500 of the largest companies in the United States. The Dow Jones is 30 large companies. The NASDAQ is every stock traded on the NASDAQ exchange. But when we get into these diversified or blended, what they're doing is they're adding something else in there. That index might only be 50% stocks and 50% bonds. Or hell, there's all kinds of stuff they come up with. And that is going to bring down its performance, okay? But they do that because they're trying to get a more consistent performance. So it's not completely bad. Don't misunderstand me, but you have to understand what you're looking at. There have been more guys who put money into that S&P 500 risk-controlled index that F&G offers, that people think they're going into the S&P 500 with a really low spread. And then they go, hey, you know, the S&P did 10% this year, why didn't this? Well, because it wasn't really the S&P. So that's what I wanted to point out. Make sure you understand that. We'll do a session someday on indexes so you really understand how they work. So any other questions you guys got today?
I'm good. I think I'm pretty
Okay, well, you know where to find me. You know where to find me. And one of the things that I would tell you, Lori, is because you're likely to encounter this. I know that you don't decide what strategies people are going into and all of that, but I imagine you get questions by people when they're looking at their statements or renewals or things like that. Feel free to call me if you can't get a hold of Brian when it's a question and say, can you explain this to me? I probably can if I know what they were into and why. Okay, so
absolutely. Nice. Thank you.
And so anyhow, okay, so that's going to end today's session. What we're going to do tomorrow is continue this, and we're going to look at the third and fourth most common types of strategies. They are called the monthly cap, okay, which is technically called an additive, and then we're going to understand how something called a performance trigger works, which is the simplest. But we'll do those tomorrow. I want you guys to just kind of digest what we've done so far today. Everything we learned today is going to apply to tomorrow's as well. So with that, you guys have a good day, and we'll see you tomorrow.